and I'm going to broadcast. All right, the attendee count has stabilized, so let's begin. I want to welcome you all to the third edition of the Emerging Scholars Month in the Microstructure Exchange webinar series. Today we have Thomas Ernst from currently MIT and soon University of Maryland, who will talk about stock-specific price discovery from ETFs. And the discussion will be Thierry Foucault. Just to repeat the rules of the game for this particular series, Thomas will talk for 30 minutes uninterrupted. Afterwards, Thierry will discuss the paper for 15 minutes. And then we have a Q&A of 15 to 20 minutes. Thomas agrees to stay on for a little bit after, yes, if there are further questions. I still want to encourage you to type Q&A questions into the Q&A function so that we can address them. But I may call on you when it comes time for the genuine Q&A to ask a question in person. So with that, I'll yield the floor to Thomas, and I'm looking forward to hearing your talk. Thank you.
All right. Thank you, Andres, and thank you to the organizers. My paper is going to look at how ETFs contribute to stock-specific price discovery. So the research question is, how are ETFs changing price discovery? ETF is just a basket of stocks. Take stock A, take stock B, and bundle it in a basket. ETFs have had tremendous growth over the last 10 to 15 years, but what I'm going to focus on today is that they've had a huge surge in trading volume. If you look at a typical day on the stock market, around 2/3 of trading volume comes from individual stocks, but over 1/3 of trading volume actually comes from investors trading baskets. This dominance of ETFs has raised some concerns. So on this slide, two quotes which highlight some concerns from market participants. The general concern is that ETFs are replacing stocks. So Bank of America reports that over a 10-year period, their clients bought a net $160 billion worth of ETFs, and at the same time, they sold $200 billion worth of single stocks. A BIS quarterly report describes the concern with this switch, which is that when investors switch to trading ETFs, they have scant interest in the idiosyncratic attributes of the individual securities in an index. They do not devote resources to seeking out and using security-specific information. Hence, an increase in the share of passive portfolios might reduce the amount of information embedded in prices, contributing to pricing inefficiency and the misallocation of capital. We could think about this in a Grossman-Stiglitz setting as the thought that noise traders are switching from individual stocks to ETFs. This would lead fewer noise traders in individual stocks and leave informed investors with lower incentives to acquire stock-specific information. My paper is going to show a model and evidence on how ETFs contribute to stock-specific price discovery. In my model, the effects will depend on the stock. First, I find that traders in large or medium stocks can actually access ETF liquidity. In the model, if noise traders switch to ETFs, informed traders follow them. They trade both the stock and the ETF in tandem. I present empirical evidence for this. I document simultaneous, same direction trades in the stock and ETF. I show that these simultaneous tandem trades are driven by stock-specific information. They're profitable. On average, these tandem trades earn negative realized spreads. People placing these trades are earning money. And these trades are sizable. Around 1 to 2% of total ETF trading volume comes from these tandem stock ETF simultaneous trades. So for large or medium stocks, the effect of ETFs is blunted because informed traders are able to adjust their strategy to take advantage of ETF liquidity. I show that concerns, therefore, are localized to small stocks. In the model, investors in small stocks do not trade ETFs. The adverse selection they face in the ETF is too large for it to be worth it. Empirically, I show that there is no tandem trading evidence in small stocks. So our concerns over ETFs harming individual price discovery are going to be localized to small stocks. Now, to place these findings in the broader literature, there are a lot of papers on both ETF theory, index funds, and even just correlated assets. In my paper, investors strategically trade the stock and ETF in tandem. Traders face a position limit, so it's not free to trade the ETF. This tandem trade is only justified for investors in large or volatile stocks. As a result, the effect of ETFs on large or volatile stocks is blunted, and it's concentrated in small stocks. On the empirical side, there are a lot of papers that look at how ETFs are helping or hurting price discovery. Since everyone here, if you've been watching all the papers in the series, would have seen Eric Budish's paper that he presented a few weeks ago, I'm going to focus on that one. Now, in Eric's paper, he exploited exchange latencies to document simultaneous messages. I'm going to use a similar trick of exploiting exchange latencies, but I'm going to look at simultaneous trades where there's a trade that happens in the stock and the ETF at the exact same time. I'm going to use this trade level data to document this tandem stock ETF trading. I'll show you that it's driven by stock-specific information, and it will allow me to document how this stock ETF relationship varies with stock-specific characteristics. That large stocks have a different relationship with ETF than small stocks. Okay, so now that we've placed these findings in the broader literature, in my short 30-minute talk today, I'm going to do three things. First, I'm going to give a practical example of the model ideas. I'm going to show that investors place tandem trades only for large or volatile stocks. Second, I'm going to describe the empirical identification strategy. I'll show you how I document these simultaneous same direction stock ETF tandem trades. And third, I'll highlight key results, showing that tandem trades are profitable, driven by stock-specific information, and a sizable share of ETF volume. So, to the first point, when and why do traders trade both? Most ETFs are actually value weighted, so they're rather concentrated. I have on this slide showing the holdings of the technology sector SPDR, which trades under the ticker XLK. It's value weighted, so a stock like Apple or Microsoft makes up a large part of the technology ETF's holdings. So I want you to imagine that you're an investor with an informational advantage about Microsoft. Microsoft makes up 20% of the technology sector, so you can't help but find yourself with an informational advantage about this technology sector ETF. If you don't trade the ETF, you're effectively leaving money on the table. You can exploit your information both in Microsoft stock and in the technology sector SPDR. The next stock I want to highlight is PayPal. Now, PayPal is just 2% of the ETF. That might seem small, but volatility is non-constant. So if you imagine a day when PayPal has serious information coming out, PayPal's volatility could be 5 or 10 times that of the other stocks in the exchange. So even if PayPal is a small part of the technology sector, it can explain a lot of the sector return if it moves around a lot. And on those days, investors in PayPal will find themselves with, again, a serious informational advantage in technology sector ETF, and they'll be able to trade on that. The final stock I want to highlight is Xerox. And for Xerox, it just won't make sense to trade the technology sector. It's 0.1%. Even with high volatility, the share of the technology sector explained by Xerox is very low. And if you're a trader in Xerox, you don't want to trade the sector, both because it's a large amount of capital for a small amount of exposure to your stock, and you'll also come up against traders who are much better informed, people who know about Microsoft stock. So investors in small stocks are going to be shut out of the ETF. So the model insights show that there's this difference in when investors trade stocks and ETFs in tandem. Now, tandem trading does offer more liquidity than trading the stock alone, but it requires sufficient weight or informational asymmetry. So traders in large or medium stocks can access ETF liquidity. These are stocks like Microsoft or PayPal. And when investors are able to access liquidity in both markets, the effects of ETFs are limited. They're able to profit from noise traders in both markets, and they maintain their incentives to acquire stock-specific information. Our concerns about ETFs are therefore going to be localized to small stocks, stocks like Xerox. Investors in a stock like Xerox cannot access ETF liquidity. Once that liquidity moves to the ETF, it's gone for good for Xerox investors. Okay, so now I've given a practical example of the model ideas. So the next thing I'm going to do in my presentation is describe my empirical identification. I'm going to show how I document these simultaneous same direction stock ETF trades. So from the model, I want to show that investors trade stocks and ETFs in tandem. To do this, I'm going to use TAC data. Now, TAC data is anonymous, so I can't just directly look and see what investors are trading. But TAC data is extremely detailed. It contains every trade and quote. That's almost 30 gigabytes per day of data. And TAC data has the advantage of being extremely high resolution. Starting in August 2015, trades are timestamped to the microsecond. The question I have is, can we tell if investors trade multiple securities? Well, what if they traded both securities simultaneously? Now, why would they invest simultaneously? If you think about Michael Lewis's book, Flash Boys, it was a 2014 bestseller, presents the common practice in exchanges of trading across multiple data centers simultaneously. That prevents front running. If you trade at New York Stock Exchange, you should also place a simultaneous trade at the NASDAQ. I'm going to do a multi-asset version of this idea. If investors want to buy both the stock and the ETF, buying both at once prevents either side of the trade from being front run. Now, for this to work, there's going to be a few things I'm going to have to rule out. I'm going to have to rule out that these trades are somehow responding to each other. I'm going to have to rule out that these trades are due to chance. And I'm going to have to rule out an alternative story, like that these trades are hedging or arbitrage. So to the first point, how can I rule out that trades are responding to each other? Well, that comes down to the question of how fast could a trader respond? For empirical work, working with TAC data, I do all the analysis on a server. You can see that picture here. Sending a message between two nodes of this server takes about 150 microseconds. Now, exchanges have much lower latencies than research clusters, but it's still bounded. So I have here a picture of an exchange. Limit order book in green is where trades take place. And to get to the limit order book, all traders, whether you're a co-located high-frequency trading firm or whether you're coming from outside the exchange, have to pass between the gateway and the limit order book. And this process takes time. Across all the major exchanges, it takes at least 20 microseconds. So I'm exploiting this same Eric Budish exploit in his paper a few weeks ago. The idea is that because it takes time to trade from the gateway to the limit order book, if we see two trades that are less than 20 microseconds apart, I can be sure that one of those trades is not responding to the other. The next thing I have to rule out is that these trades happened at the same time just due to chance. So what I have here is a timestamp of a trade. Let's suppose that Microsoft stock traded at 10:32 a.m. So we have 10:32, a few seconds, milliseconds, and microseconds. So what I'm going to do is for every single stock trade, I'm going to check plus or minus 20 microseconds if there was a simultaneous trade in the relevant ETF. So for Microsoft, it would be the technology sector SPDR. Now, I want to make sure I'm not picking up chance trades, so I'm going to also look at a level of baseline trading. Look plus or minus 1,000 to 2,000 microseconds. And this will capture trades that happen close, but not exactly at the same time. That'll rule out any sort of chance trades. And so for the remainder of the talk, when I say simultaneous trades, I'll actually be looking at the difference of these two regions to control for chance trades. To give you a graphical picture, I've plotted cross-market activity between Microsoft and the technology sector SPDR for a single day on the stock market. At 0 here, I'm counting up how many times the technology sector ETF and Microsoft traded at the exact same microsecond. As you can see, right around 0, there's a very large spike in simultaneous trading activity. There's a very deliberate effort by investors to trade both these assets at the exact same time. If we go further out, you can start seeing the arbitrage reasons where, say the ETF trades followed by the stock, or the stock trades first followed by the ETF. I go out a little bit further to get out of this arbitrage to estimate this baseline level of activity, to control for a very small but non-zero level of trades that would happen at the same time just due to the chance. So now I've ruled out that these trades are responding to each other or that they're just by chance. So the third thing I have to rule out is an alternative story, like hedging or arbitrage. I might worry that these simultaneous trades are something like ETF arbitrage. So to rule this story out, I'm going to sign trades. And I can sign them as either buy orders or sell orders. I explore the different algorithms in the paper to do this. The simple idea is if a trade happens at the best bid, that's a sell. And if a trade happens at the best ask, it's a buy. And I find that these simultaneous trades are overwhelmingly in the same direction. So I've plotted an example here. Along the x-axis, I'm taking all the times that the stock order was a buy order. And I'm checking whether that simultaneous ETF trade is also a buy. And so if you look at the right of the axis, 100%, that would be all the buy orders in the stock being paired with buy orders in the ETF. On the y-axis, I'm doing the same thing for sell orders. You can see that simultaneous trades are all in the top right part of this graph. Investors are either buying the stock and buying the ETF or selling the stock and selling the ETF. Baseline trades are actually much closer to 50-50, which fits with the idea that those are just chance. And so this fact that these simultaneous trades are in the same direction is inconsistent with hedging, and it's inconsistent with ETF arbitrage. So now I've documented this empirical identification strategy of these simultaneous same direction stock ETF trades where investors trade the stock and the ETF in tandem. So now let me go over my key results. The first main result is that stock-specific information drives these tandem trades. I'll show you that trades are a sizable share of ETF volume and profitable. And as time allows, I'll go over some extensions of the results, both to other ETFs and to non-ETF assets. So to test this prediction of what's driving simultaneous trades, I'm going to run a panel regression. The prediction from the model is that when investors have a large piece of informational asymmetry about a large ETF weight stock, that's when they want to trade the stock and ETF in tandem. I'm going to consider 3 different measures of information. The first is earnings dates. The second is intraday return. And the third would be news articles and press releases from things like aggregated by Ravenpack. And for all 3 of these information measures, I'm going to test how the simultaneous stock ETF trading volume varies with information measures. I'm going to use a sample of ETFs, SPDR, and the 10 sector SPDR ETFs, along with their 500 underlying stocks. Together, these ETFs represent over 30% of total ETF trading volume. I'm going to use microsecond TAC data from August 2015 to the end of December 2018. So to give you just before I go over the regression, a simple graphical example. What I've plotted here are simultaneous trades between the Energies ETF and 2 large energy stocks. ExxonMobil in blue is 23% of the Energies ETF, and Chevron is also 22% of the ETF. You can see that same clear spike at 0 of exactly simultaneous trades. And you can see how this level of simultaneous trading varies with the changes in stock-specific information. On a day when Chevron has a large return, there's a large spike in Chevron ETF simultaneous trades. And on a day when Exxon has a large return, there's a very large spike in Exxon ETF simultaneous trades. So to turn this into a regression, I'm going to look at simultaneous trades between stock I and ETF J on date T. And I'm going to look at how that varies with the weight, the information measure, and interaction between the weight and information measure, and a series of controls. So the controls I'm going to control for the ETF return, the absolute ETF return, and an ETF weight interaction. So to make sure that these trades are driven by stock-specific information rather than factor-wide information. My theory predicts that alpha 3 should be positive. When there's a large informational asymmetry and it's in a large weight stock, investors are going to want to trade the stock and ETF in tandem. And this is the results of that regression. So if you think about a large stock like ExxonMobil, on a typical day, there are 800 simultaneous stock ETF trades. On a day with an earnings date, there's about a 15% increase in simultaneous trades. On a day when ExxonMobil has a 1 to 2% higher return, there's a 50 to 100% increase in these simultaneous trades. And these increases hold controlling for the ETF return. Now, the ETF return is somewhat collinear with the return of the individual stock because it's such a large part of the exchange. So the next thing I'm going to do is use Ravenpack, intraday news articles, to estimate this effect. Now, the advantage of Ravenpack is that these are events that occurred during the trading day. And so I can look over a small window of intraday data, how this simultaneous trading behavior changes around the small window around an informational event. So I plotted here on the right is suppose that Microsoft has a news story. Microsoft is in the technology sector spider. So I'm going to measure for a 5 or 30-minute interval around the publication date of this news story or press release, the simultaneous trading between Microsoft and the technology sector. I'm going to also measure that simultaneous trading volume for every other stock in the sector. So I'm going to look at Apple, look at PayPal and the technology ETF and all the other stocks. And what I want to see is that, first of all, Microsoft, because it has the story, the stock with the news event will have a much higher level of simultaneous trading, and that this effect will be larger for larger stocks. So here I'm looking at total trades per hour over these different windows. And for both a 5 and 30-minute window around the event, there are more of these simultaneous stock ETF trades for the stock with the news event. And larger weight stocks see even more of these trades. Next, I'm going to do a simple placebo test. You might worry that large stocks are different from small stocks, and that's what's driving the results. So I'm going to take the Invesco equal weight SPDR ETFs. What's nice about these ETFs is that they're the exact same stocks as the sector spiders, but they're equal rated rather than value weighted. So in this set of ETFs, large market cap stocks should look no different than small market cap stocks. So as you can see, the traditional sector spider, ExxonMobil is 23%, Chevron is 22%. In this equal weight portfolio, they're each 3%. And so I'm going to do the same regression, but now with the value of the market cap rather than the ETF weight. What I find is that there's a small non-existent effect. And so these results are not driven by the market cap in these equal weight portfolios. It's really the ETF weighting that is driving these simultaneous stock ETF trades. And finally, I want to take a second to consider whether these trades line up with what they should look like. Now, they're a measure of the stock ETF tandem trading behavior, and I've just argued, presented evidence that they're driven by stock-specific information. So the first question is, do these trades actually appear informed? And yes, they do. They earn, on average, negative realized spreads. So realized spread is just the difference between the trade price versus the mid-quote from 5 minutes after the trade. And both sides of the trade are profitable. There's a profit of about 1 penny on the stock side of the trade and half a penny on the ETF side of the trade. The next question is this tandem trading a big deal? Is it a sizable share of market volume? And it absolutely is. Simultaneous trades are a large share of trading volume. Around 1 to 2% of ETF trading volume actually comes from these stock ETF simultaneous tandem trades. So we've tested the main model prediction that large information and large weight together drive this increase in simultaneous trades. I used 3 different measures of information: earnings dates, intraday return, and news articles and press releases. And we see that these simultaneous trades are a profitable and sizable share of ETF trading volume. I'm now going to present 2 different extensions of the model. The first extension is trading spider with sector information. I'll show that each sector spider gives informational advantage about spider, just like underlying stocks give an informational advantage in their sector. The second extension I'll present are stock ETF triples, where investors trade 3 assets at once. And this gives an alternative test of large versus small stocks. So I've plotted here sector spider with SPY. Now this tandem trading strategy really doesn't have to be unique to ETFs and their underlying. It really makes sense for any 2 sufficiently correlated assets. Now just from the sample I presented, I have such a correlation between spider and the underlying sector spiders. Right? You can think about dividing SPY into this sort of meta ETF of each of the underlying sector spiders. And each sector is a very large component of the S&P 500. So for example, the technology sector is almost 30% of the overall S&P 500 spider. So if you're an investor who has an informational advantage about the tech sector, you also have an informational advantage about S&P 500. So I can do that same regression using the sector return and the sector weight, and I find that a large sector return leads to far more of these simultaneous trades, and large sectors see even more of these simultaneous trades than small sectors. And the other extension I want to highlight then are triple trades. Triple trades occur where investors trade stocks, an ETF, a sector ETF, and spider at the same time. So we know that investors trade stocks in the sector ETF, and we know that investors trade the sector ETF and SPY at the same time. So what about trading all three? Well, that triple trade only makes sense if you have a large weight in all three. So if you think about Apple, Apple is a large stock, so it's large in the technology sector. And the technology sector is also large. So Apple's overall weight in the S&P 500 is also large. The same can be said for Amazon. It's a large stock both in its sector and the overall market. If you look at a company that's large, but in a small sector, like the American Tower Corporation, it has a very large sector weight, but it's a very small stock in the S&P 500. The same is true for Linde, which is a large stock in the materials sector, but a small stock in the S&P 500. So trading all three only makes sense if you have a large weight in the S&P 500. So I can redo my same basic regression, looking at how simultaneous trades vary based on both the weight, the return, and a weight-return interaction. And what I find is what drives simultaneous trades in this triple between the stock, the sector, and the S&P 500 is your S&P 500 weight. Being a large stock in a small sector doesn't make this triple trade make any sense, and investors don't do it. It's only in stocks that are large in all three that investors trade both the stock, the ETF, and the S&P 500 at the same time. And since I have a little bit of time remaining, there's one more thing I want to talk about, which is simultaneous trades are profitable and driven by stock-specific information. And we might wonder, where do these profits go? Does it go to fundamental research about stocks, or does it go to microwave towers? Now, this is anonymous data. I can't see who's making the money, much less how they're spending it. But we could gain some insight by looking for latency arbitrage. Now, if we think the money is being spent on microwave towers, we should check for whether trades line up with the shortest latencies. So I'm going back to this picture of the exchanges. And what you see here in the red is the same exchange red path. The idea is if a trade happens at the limit order book and someone wants to respond to it as quickly as possible, that's going to take about 20 to 30 microseconds. If you want to respond to a trade that happens in the New York Stock Exchange on NASDAQ, you have to go across exchanges through the air, and that takes a longer 150 microseconds. So the question is, before these simultaneous trades, do I see a precipitating event? Do I see a trade that lines up with latency arbitrage within the same exchange, or do I see a trade that lines up across exchanges? So I can measure that, and I don't see these trades. So here at 0, I'm plotting exactly where simultaneous trades happen between, say, Microsoft and the technology sector ETF. I can measure how many trades happen in this same exchange latency window, and I can measure how many trades happen in this across exchange latency window. And I find that simultaneous trades don't line up with latency arbitrage. Over that entire same exchange window, only 2% of simultaneous trades are preceded by a stock or ETF trade. And over the entire 100 to 200 microsecond interval looking across exchanges, only 30% of simultaneous trades are preceded by a stock trade. And so that's consistent with these trades being a strategy to avoid latency arbitrage. We think back to Michael Lewis and Flash Boys. This is great because the technical sophistication required to place a trade in minimal time is high, but the technical sophistication to avoid this latency arbitrage by, say, trading the stock and the ETF at the same time is actually quite low. And it looks like it's effective, that investors are able to access liquidity in both the stock and the ETF. So with that, I will conclude. How do ETFs affect price discovery? Well, I show that they contribute to stock price discovery, but the effect depends on stock size. If you're a trader in a large or medium stock, you can access ETF liquidity. Empirically, I present the evidence that investors trade both assets in tandem. They place simultaneous, same direction trades in the stock and the ETF. These trades are driven by stock-specific information. These trades are profitable, earning negative realized spreads, and they're sizable, around 1 to 2% of ETF trading volume. This means in the model, because investors are able to access liquidity in both markets, the effect of ETFs is limited. Instead, the effects of ETFs are concentrated to small stocks. Empirically, I don't see evidence of tandem trading. And in the model, investors with small stock information cannot access ETF liquidity. And so small stocks are the ones which are most harmed by ETFs. So with that, I'll turn it over to Andreas for Thierry.
Thank you so much, Thomas. This was very insightful. Great presentation. Before we move on to Thierry, so I can see already that there's a very lively Q&A, and we're looking forward to all the discussions you're going to have. But before we go there, and this actually adds to it, is I want to launch a quick poll where I want to know from you guys, from the audience, whether or not in the remaining 3 talks, we should actually break for the Q&A. So the poll is not up. If you could just quickly respond to that so that we get a sense of maybe we want to change the structure a little bit. So the question here is, again, should we just have breaks for 1 or 2? The questions will be asked by the moderator just to break up the talk a little bit. All right, while people are clicking on yes or no, I will hand it over to Thierry, who is kindly agreed to do the discussion and for which we're very grateful. Thierry, the floor is yours.
Okay, let me share my screen. Okay. Okay, thank you. So hello everybody. I'm very happy to discuss this paper. It's very interesting. So the main research question, the big picture question, is whether we should be concerned about a negative effect of ETF on price discovery. And the way Thomas is looking at the question is by showing that by providing evidence that there are informed trades based on stock-specific information in both the ETF and underlying stocks. And it takes that as evidence that we should not be that concerned, at least for large and medium stocks. The idea is based on theory. So the theory that he provides shows that under some condition, it is optimal for investors with stock-specific information to trade both in the ETF and in the stock. And then what Thomas does is to test some implications of the theory. So my main concern is about whether the evidence provided in the paper is sufficient to address the big picture question. So I will come back to that. But before this, I would like to come back on the theory. So the theory is an extension of the Glausten and Milgram model. It can be viewed as a static model, as a static multi-market version of this model, in which you have 3 assets: stock A, stock B, and an ETF which is made of stock A and B, of the 2 stocks. And informed investors in the model can trade. Informed investors have stock-specific information on A or B, and they can trade exactly 1 share of the asset, either in the ETF or in the stock in which they have information. And noise traders cannot trade in multiple markets at the same time. So those are the key assumptions of the model. And what Thomas shows is that there are many possible equilibrium configurations that happen in this case. But the main idea is the following, which is if the weight of a stock in the ETF is large enough, so let's say that for stock A, the weight of A in the ETF is larger than threshold, then it is optimal for an informed investor with information about A to trade in both the ETF and the stock. So in the model, that means it is optimal to use a mixed strategy. Given that traders have to trade exactly 1 share, they cannot split their trades between the ETF and the stock, so they are going to mix. And the intuition is relatively straightforward. It's an intuitive result, which is, imagine that the weight of stock A is very large in the ETF is very much like stock A. So if the bid-ask spread in stock A is becoming too large, then it is optimal for the investor to start trading in stock in the ETF. And this is going to work to equalize the bid-ask spread so that the investor is indifferent between trading in the ETF or trading in the stock. So that's a key result. There are cases, parameter values, for which it is optimal for an informed investor with stock-specific information to mix, to randomize in his routing decision between the ETF and the stock. That can be optimal for each type of investor, investor with information about stock A and investor with information about stock B, or only for 1 type of investor. That depends on parameter values again. So that leads, to those many configurations. But I will focus on the case in which this is optimal, if you wish, for all investors. So that's called a pooling equilibrium by Thomas. So in this case, the mixing probabilities, and I think this is important for the empirical analysis, the mixing probabilities and the threshold 5-star depend on all the parameters of the model. That means that, for instance, a shock on noise trading in stock A is going to affect indirectly the bid-ask spread in market A and the routing decision for the investor in market A with stock-specific information in A, even though the payoff of the 2 assets are independent. So there is sort of, a spillover in liquidity from B to A through, you know, the presence of the ETF. This is sort of a standard result when you have multiple stocks with independent payoff and a basket of the stocks. But what I find interesting here is that this has implications, additional implications for testing the model. So I will come back to that. Now, how to test the model? So a key prediction of the model is that when the weight of, let's say, stock A in the ETF goes up, the likelihood that an investor with stock-specific information is going to trade in the ETF is increasing. So this mixing probability with which, you know, the investor is splitting his order, if you wish, between the two markets is increasing when the weight of A in the ETF is going up. So the question is how to proxy for this mixing probability. I mean, in the model, people don't split their orders between the two markets. They are not allowed to do that. So the first assumption to make is, well, we are going to assume that when the mixing probability is less than 1, this is as if traders were splitting orders between markets. This is a sort of a jump from the model to the data. And how do we proxy for trades which are driven by information? Well, what Thomas is doing is to look at simultaneous trades between a stock and ETF. By that, he means market orders in the same direction, which are placed almost exactly at the same time in the stock and the ETF. And then the testable hypothesis that you get from the model is that when the weight of a stock in the ETF goes up, then the frequency of those simultaneous trades in the stock and the ETF should go up. So that's one prediction of the model. There are many other predictions, but almost all the tests in the paper are about this particular prediction. So Thomas already explained, you know, the data that he's using for the test. I'm going to skip that. What are the main findings? So the main findings support the main testable hypothesis, which is it is the case that when the weight of a stock in the ETF goes up, then the daily frequency of simultaneous trades between the ETF and the stock goes up as well. And this is especially the case on days in which you have news events for the stocks, like, for instance, earnings announcement. Okay, so what are my comments? So my main comments is whether really we can conclude from the paper that there should be no concern about the effect of ETF on price discovery, at least for large and medium stocks. I don't think this is the case. I don't think, you know, from the fact that traders are using both markets, we can take comfort that the presence of ETF might not discourage the production of information, of fundamental information about the stock. In fact, I even think that this question could be addressed in the theory, and I think the theory is probably making not so clear prediction about that. So let me explain the logic here, which is in the model, the reason why it might be optimal for the investor to mix with, let's say, an investor with specific information about stock A. Why it might be optimal for the investor to mix between stock A and ETF is because when his trade becomes too informative, maybe because there is little noise trading in stock A, so the bid-ask spread in stock A is going to be large, but that's also because the trade of the guy is informative, then it becomes optimal for the investor to start trading in ETF with some probability, even though, you know, the return per share is going to be smaller because the weight of the stock in the ETF is less than 1. But what this logic means is that this is a strategy for the investor to blur inferences about the payoff of the stock from the rest of the market. And so my hunch is that, my intuition is that in this model, the presence of the ETF is going to slow down the speed at which price discovery takes place. So at least, you know, I think this question should be checked. Whether or not my intuition is correct can be checked in the model, and it should be checked because this is the main question of the paper. My second intuition is that if you take the amount of noise trading in ETF large enough, then in this case, it's certainly the case that if you introduce the ETF, you are going to reduce the speed of price discovery because you are just injecting noise in the market. So if you compare the situation with the ETF and without the ETF, if the volume of noise trading in the ETF is large enough, it's very likely that you are going to conclude that the ETF is bad for price discovery. So just based, you know, on the model, my expectation is that it's not so clear that finding that the investor split his order between the ETF and the stock is sufficient to conclude that ETF is not a problem, you know, for price discovery. And a more general comment on that, I think it's very difficult to analyze the effect of security design or market design on price discovery, taking information acquisition choices as given. In fact, that sort of, you know, that was mentioned to some extent in the citation of this citation from the BIS report by Thomas at the beginning. I think one possible concern is that the presence of the ETF may discourage the production of information in the first place, or may encourage the production of fundamental information in the first place. But the only way to have this question is to look at whether the presence of the ETF is encouraging the production of information about a given stock. And I think I have the same concern for the empirical part. I mean, the empirical part shows clearly that simultaneous trades are informed. So there is evidence that people with stock-specific information trade both in the ETF and the stock. I'm convinced that this is happening after reading the paper. But that's not sufficient to conclude that without the ETF, then there will be price discovery in a large stock will be worse. For this, I will need to conduct empirically a more complex experiment. So I think, you know, I will be more careful about the conclusion of the paper. I think that it's clear that there is evidence of informed trading based on stock-specific information in the stock and ETF, in the stock market and ETF. I'm less convinced that from the paper we can conclude that for large stocks, ETF do not harm price discovery. Also, you know, on the theoretical side, I think it would be useful to discuss a bit more the connection between the analysis in the paper and earlier analysis in the 90s about how informed investors with stock-specific information trade in the presence of a derivative market. There are many papers on that. There is a paper by Bruno Bien and Thierry Foucault, a paper by Isley, O'Hara, and Srinivas, and so on and so forth. And of course, an ETF is not exactly like an option or a futures on a stock, but there are connections. So it will be interesting, you know, to link more the paper to this earlier literature. And more generally, I think it will be very useful to derive comparative statistics about the effect of the parameters on the mixing probabilities, especially in the pooling equilibrium. So you do that in the semi-separating equilibrium. This is very useful. But I think doing it as well in the pooling equilibrium will be useful because that's going to generate additional predictions that you can test in the model. And so this is my next point, which is most of the tests in the current version of the paper are about the effect of a change in the weight of a stock in the ETF on the frequency of simultaneous trades between this stock and the ETF. So that's nice. This is a clear prediction of the model. That is when this weight goes up, you should see more simultaneous trades according to the model. But there are many additional predictions which are interesting because the mixing probabilities and so the frequency of those simultaneous transactions, according to the model, should depend on all parameters of the model. For instance, the amount of noise trading in the ETF, or for a given stock A, the amount of noise trading in stock B, or stock C, or stock D. And so this is very nice because those predictions are far from being obvious. They are really related, you know, to the economic mechanism in the model. So I think testing, you know, those additional predictions, rather than just focusing on whether when there is a change in the weight of a stock in the ETF, we see more or less, you know, simultaneous transactions between the ETF and the stock, that will be probably a stronger way to provide evidence in favor of the model. Last question, I'm not sure this is very important question, but I was concerned about reverse causality at some point, which is you regress simultaneous trades in a day on the weight of a stock in the ETF J in the same day, but the weight depends on the price of the stock during the day, which itself is going to depend on informed trading during the day, which itself is going to depend on simultaneous transactions. So I think there might be an issue of reverse causality. I'm not too sure, but maybe you want to discuss that a little bit more in the paper. So those are my main comments. So overall, I think that this is a very interesting paper. It provides convincing evidence and convincing theory that people with stock-specific information should may find optimal to trade both the ETF and the stock. I'm less convinced that the paper provides evidence that ETFs do not harm price discovery, especially even for large stocks. And I think that more work is needed to fully test all implications of the model. That will make the paper stronger, I think. So thanks a lot.
Well, this was a great discussion. Thank you, Thierry. So we have a very lively Q&A open. And now, Thomas, I haven't told you this ahead of time, but I'm going to tell you now. Yeah. This being the MBR rules, you cannot directly respond. I will not give you the opportunity to respond directly to Thierry's comments. Okay. But maybe there are some of the questions in the Q&A that allow us to respond.
Sure. So let me actually start.
But we get that. Well, what? Wait, no, you're not. Oh. So the question will be asked. I'm so sorry. Okay. I'm so sorry to interrupt you. But we have the people who ask the questions, and I would like to ask them to ask them themselves. So Mina, your question is the highest voted one. Maybe you should start. Where is Mina? Where can I find her? I'm going to allow you to talk, even if you haven't raised your hand. The raise hand function is actually enabled. So Mina, if you want to ask a question.
Hi, but I think Thierry actually addressed my question. So I thought the main research question was the effect of ETF on stock-specific price discovery, but just the fact that the investors can use ETF to take advantage of stock-specific information, it doesn't mean that the existence of ETF or more prevalence of ETF necessarily improve stock-specific price discovery. I just wanted to clarify that. Yeah,
sure. So I think I want to say a little bit more about that too. So one thought is, what's the overall effect of ETFs? Is it net positive or negative? And when I say that, the effect on large stocks is limited, I do think that the overall effect would be negative. If you're a large stock trader, you would always prefer more noise traders in your stock than in the ETF. It's less pleasant to go after noise traders in the ETF than if they were just in your stock. And this is something that I think is hard to measure empirically, but that's one advantage of the model is I can think about how noise traders might be changing when the ETF is introduced. So if we think about the world with an ETF versus the world without, I explore in the appendix a few different assumptions about how these worlds might differ. The base case assumption is that all the noise traders in the ETF really just want factor exposure, and without the ETF, they would be trading each individual stock in accordance with its market weight. Another alternative thought might be that the ETF really is attracting new noise traders. And in that case, the net effect of the ETF could be positive. If there are people who are previously sitting out of the market, and now that the ETF is introduced, they think that's, it's reduced their trading cost enough that they want to start trading and hedging maybe a market-wide risk. And so changing that assumption about how noise traders change can change the overall effect. And I think the overall effect is probably negative, but the effects are going to be very limited for the larger stocks. And the more larger the stock is, or the more severe the informational asymmetry, the more limited that effect is because traders can trade both.
Okay, next, the next highest question is by your future colleague, Pete Kyle. Pete, maybe you want to, I just allowed you to talk, so maybe you want to ask a question yourself?
Can you hear me?
Yep.
Yeah, okay, well, first of all, welcome to the University of Maryland.
Thank you.
My intuition is that the number of simultaneous trades would be a function of the intraday variance of the returns of the stock like Microsoft. You put absolute return and number of news events in as proxies for that. So I would think that if you could measure intraday variance very accurately, the significance of the absolute return and the news events would go away. So what do you think?
I think, I should add in just the intraday volatility. That would be a great measure to add in. I think the nice thing about, at least from talking with people outside Microstructure, I found that people really like these other measures because they see them as more fundamental. That if there's a news article, they see that as, oh yes, there's stock-specific information in this stock. And so that's why I focused on those measures. But I totally agree that volatility definitely makes sense as just, a raw measure of, is there information in this stock which could move the overall ETF price?
Okay, so the next person next highest voted questions by Thierry Liu, who have just been able to talk. Maybe you want to ask a question live?
Yeah, so can you hear me?
Barely. If you could speak up a little, would be good. Oops, sorry. My bad. I just screwed up the tech. 1 second.
Okay.
Yeah, there you go. Sorry. Can you try again?
Okay, can you hear me now?
Yes.
Okay.
I can turn my volume up.
Sorry, I'm trying to yell into the microphone. My question is, do you see patterns in the distribution, temporal patterns in the distribution of the simultaneous trade? So I'm thinking about, you know, at market open and close. So at 9:30 and 4 p.m., obviously we're going to have a huge rush of volume. But then also in terms of the pre and post market hours when those earnings releases actually come out. Presumably there would be different motivation there for the trades, right? If we look at when the earnings releases, obviously new information is coming out, whereas at 9:30 and 4 p.m., we could still see a lot of simultaneous trading going on, but that's, you know, just more of the effect of the market opening and closing.
Yeah, great question. So the first question, the first point, you know, we see a lot of more volume around the open and close. So one of the robustness checks, and should be somewhere in the appendix, if not, I'll make sure to add it, is I cut off the last 15 minutes and first 15 minutes of the day to make sure that the results are robust to any sort of open close surge in activity. And I also have that baseline estimate of trading volume. So that baseline would also be higher. If there's, you know, a lot of trades that are just happening because trades are all concentrated at the open or close, that should also really increase that baseline level of trading. And so I control for that there. And then the other big trade timing pattern that I worry about is actually trades at the millisecond level. So Hasbrook and Saar have a nice paper in 2013 that documents that there's a huge surge of trading every 1 second at these even 1 second intervals. And so again, you might have the worry that because trading, you know, is concentrated at these even regular moments, that might lead to spurious, you know, simultaneous trades. So to control for that, I also do the same regression where I cut off trading that happens in that surge within each second. And what's great is that if you look at just the last 3 digits of a timestamp, those 3 microsecond digits, it's perfectly uniform. It's a very uniform distribution of when these trades happen, at least at the microsecond level, even if there's patterns in the rest of the timestamp. And then I guess one last part of your question is, what about outside, you know, outside of market hours? There's usually not much. You know, the problem with liquidity outside of the market is that it's not like there's regular quotes where you can go and simultaneously take advantage of both the ETF quote and the single stock quote. So I don't see much there.
Okay, so now I have and had done this for a while, enabled the raise hand function. Most of the questions that are now in the Q&A have about the same number of votes, which is between 0 and 2. So maybe I'm just going to ask the audience members to raise their hands if they want to ask the question live.
I'm also happy to combine. Okay, go ahead.
You want to respond to some things? Thomas, that's fine too.
If you want, I can just, I mean, if people want to ask, I'm happy to have them ask. I can also read aloud. So I think Marius has a good question, which is, or maybe I'll start with SN, which is, do I check if tandem trades are more profitable than non? And the answer is absolutely, they're more profitable. So if you think about a normal trade, it's going to be a positive realized spread. People normally pay money to the market maker to trade. And it's really the market makers usually make money, and they lose money when they get hit with these tandem trades. The next question, Marius is, great question. If a stock is included in multiple ETFs, would a trader prefer to go for the ETF where the stock has the largest weight? And the answer is absolutely. So Marius showed us that, you know, in his presentation, there's a couple of different ETFs that all track the S&P 500. The one I look at is SPY because that's really where the liquidity is. And that's where it makes sense if you want liquidity to go for it. And Jose? Do you want to ask your question?
Yeah, so your theoretical model compares the liquidity on both markets, and you get the pooling only under certain circumstances. Mm-hmm. And I was wondering, how does these affect your actual empirical exercise? You take that into account in any way? And also, of course, how do you account for the huge difference that there can be between different ETFs, between the value weighted and the equally weighted, when you the sectoral and spider, et cetera, et cetera?
So the value weighted versus equal weighted is a big challenge. I would love to do more studying of how different stocks interact with different ETFs based on their weight, but that's a huge problem, which is that I'm not sure if I'm seeing really the effect of weighting versus an effect of liquidity. So if you think back to my placebo test, where I show that investors do simultaneously trade in the value weighted ETF for a value weighted stock, they don't trade in these equal weighted ETFs very much. The big problem there is that these equal weighted ETFs are just not that liquid. And so maybe I'm not seeing evidence just because, there's just not liquidity there, so people don't trade simultaneously. And so that's why I presented that I started going in the direction of like these triple trades. And there's a little bit more in the paper where, investors trade the sector spider and spider at the same time as their individual stock, because all three of those assets could be very liquid.
Thanks.
Ilya, do you want to go?
Sure. I just wanted to comment, and I'm sorry I wasn't online from the beginning.
Mm-hmm.
I was wondering whether you can relate your work to Lei Yu's paper on ETFs. She also used spiders and sector spiders and looked at the contribution to information. She kind of extended the original Hasbrook methodology to multivariate vector regression. Can you and looked at the at information contributions from the stocks to the ETFs and vice versa?
Yeah, sure. Great question. So I would have to double check what that paper says, but I'm guessing it's looking at the S&P 500 as a whole versus the cash market and comparing, where price discovery for the index occurs. And what I'm interested in is actually the relationship between the S&P 500 and just an individual security. And the challenge there is that it's very hard to come up with, Hasbrook's method is a great method, but it relies on some sort of covariance stationarity, and you need, usually you use the arbitrage relationship. You look, does this asset move first or does the other asset move first? When you're looking between the S&P 500 and say Apple stock, there's not a no arbitrage relationship there. There's going to be some spread in the S&P 500 and some spread in Apple. And depending on, those quotes are free to move without triggering an arbitrage relationship. The spread could get wider or narrower in one market or the other without anything having to happen. And so that's why I focus on these simultaneous trades, because it allows me to really focus on cases where I see someone trading both the stock and the ETF in the same direction. I see the case where it's also not sort of a lagged reaction where one market moves and then the other. It seems like traders really trade both simultaneously.
Right. I mean, no, she actually used looked at the relationship between the component stocks and the sector spiders.
Okay.
But it's not necessarily about the spread so much, but about the information incorporation, right? And you're right. Who moves first? Where does the information trading goes? Anyhow, if you haven't looked at it, it's useful. I mean, one of the things, paper was kind of probably the first paper to look at those things. It was like 15 years ago. And back then ETFs were not as hot as these days, so it wasn't picked up. But it will be interesting if you could kind of sharpen just the distinction with your approach. That will be helpful for us who know that older work.
Sure. All right. Thank you very much.
Sure.
All right, Chris, you're next.
Thanks. My reactions were similar to Thierry, thinking about the introduction of derivatives markets and the notion that these could be potentially completing the market, for example. So one direction you might go empirically would be to look at short interest, both short interest as well as possibly shorting costs. Have you looked at, for example, whether there's an increase in short interest in the components when the ETFs are introduced, or whether shorting costs differ across the two assets, and whether even the short interest is correlated?
Sure, that's a great question. So there's a big difference in shorting costs where it's much cheaper to short the ETF. I think Maureen O'Hara has a paper which argues that ETFs really allow you to short industry risk that you maybe previously it was very expensive to short. when I look at, sort of in the microsecond data, it looks like people, one thing I was thinking was maybe there would be an asymmetry between going double long versus going double short, and I haven't seen much of a difference there. It seems like, if investors want to trade both assets long versus investors trading both assets short, both of those simultaneous trades happen every day. They're frequent occurrences, and I haven't seen a big asymmetry there between long versus short.
Yes, that's very interesting. Thank you.
Liang.
Thank you.
Oh. Liang, you want to go?
Yes. Can you hear me now?
Yes.
Great talk, great presentation. So I have a question regarding index trading. So in your framework, how should we think about index trading? Are those people informed traders or not traders? Even if they have information, maybe they are not interested in the individual stock. They are only interested in the ETF, in the index. So this might have some implications for both theory and test and empirical test. So what's your thought?
Yeah, that's a great question. So my base assumption would be, if you think about traders trading the ETF, that they're just noise traders and they have some hedging need. They need to trade the index either long or short. And what I think about them is, if we think about the no ETF world versus the ETF, where does the ETF really attract liquidity? It attracts these sorts of traders who just want, factor-wide exposure. And you could also think even about, the previous question was a good one, where what if people are completing the market and maybe they're taking a long position in the stock and they use the ETF, just like a derivative to hedge. That hedging side of the trade I would also think of as kind of uninformed volume for the ETF. And the point of my paper then is to say, okay, all this noise trading in ETF actually attracts informed trading instead of single stocks.
Thank you. I have another follow-up question. So in the commodity market, the commodity index traders, they only trade the index. They probably not interested in commodities. Maybe that might be a way to test your model further. It's a suggestion, not a question.
Okay. Yeah. I could think about, I guess, what sort of test do you have in mind? Because when I think about commodity index, I think of that as usually tied to an individual commodity, or are you thinking across commodities?
Across commodities. So they might, in my mind, those people might be kind of both have information and noise. So there's because they might trade the commodity index, and also at the same time they might also want to hedge equity. So they might have information, both information and noise.
Yeah, so maybe a good test would be to think about, thank you for the discussion. I think maybe to think about not just liquidity in terms of trading volume varying across assets, but liquidity in terms of spreads, that some ETFs might have higher or lower noise trading, independent of volume. All right, thank you for the discussion.
So going with normal tradition, the official part of the presentation is now over because it's just 3 minutes after noon, but I'm sure Thomas is very happy to get further comments and to address maybe some of the outstanding questions that we have in the Q&A. But thank you. I want to take at this point in time to thank everybody who attended, and I also want to thank Thomas for your great presentation and Thierry for an outstanding discussion. And so now to the unofficial part.
Okay.
Right. Michael, maybe do you want to ask your question live? Michael Goldstein is lost. Where is he? Is he still there? Okay, so Michael Goldstein asked, since the informed know they are about to put in a Microsoft order, and they know that Microsoft is 20% of the index, they know that the future value of the index is going to go up, especially if they think that that their trade is going to move the price up, so if they have price impact. So in some sense, they will have some inside information about where the index is going. Even if they don't have the typical informed knowledge, they know that there will be an effect that will come from the specific trade. Is that what we might think about this?
Absolutely. Yeah, I think that's a very reasonable hypothesis of some of what might be happening, is that maybe people really know that Microsoft is undervalued and they want to buy both. But another thing might be happening, they know that they're going to consume liquidity in Microsoft and they're going to push up the price. So why not profit from a momentary price of movement in the ETF? Yeah.
So now I enable Peter to ask his question, as is a bullying move of mine. Peter, do you want to go?
Yes. You classified the stocks as informationally intensive by the number of messages, but obviously there are not more than a few news, even for Microsoft, for which you observe like 130,000 messages a day.
Yeah.
Even if there is 130,000 messages a day, it's about 1/5, I think, of a second per message. So does it make sense to make your analysis with, or at least informational section of your analysis with granularity of microseconds?
Sure. So I'm using the microseconds, just as, to identify when people trade both at the same time and in the same
Right,
direction.
I understand, yes.
But when I look at like these news events, I'm actually looking over a 5 or 30-minute window, because you're absolutely right that there's going to be a lot of these news events, and to the extent to which they're really novel news is also debatable. And so what I'm really using them as a measure is not to say like, okay, here's a news event and immediately after we see a trade. What I'm actually using them as an indication of whether there's more or less informational asymmetry in a stock. So on a day when there's a lot of news events about Microsoft, even though each individual one might not be very novel, overall we would think there's a larger informational asymmetry in Microsoft. And so then I look over that interval, like, 30-minute interval around when these news stories come out. Is there more of the simultaneous trading compared to when there's not as much of these stories coming out?
Okay.
Okay, thank you for the question.
Oh, sorry, I muted myself. Let's see, are there any more raised hands at this point? I presume Liang's raised hand is that he has got his question answered. Maybe Thomas, our speaker from next week, maybe you want to ask a question live? If so, if you raise your hand, or I could just bully you by enabling you to talk. Ah, there he is. Okay, very good. Thomas, off you go.
Hi, thanks for having me. Great talk. Yes, my question is more, I guess, a robustness question. It's relating the measure of simultaneous trades to, my understanding is right now it's a frequency measure. I was wondering if you had a look at a more size-related measure by looking at the dollar volume of those simultaneous trades instead of the number of the trades.
Yeah. Great question. So I do explore that in the index, and I find the same thing, that simultaneous volume goes up as well as just the raw number of trades. Okay. Yeah. Thank you.
So there's one more question in the Q&A from Maximilian Vogt, but my suspicion is that that question has been answered. If you think differently, then Max, please raise your hand and then you can ask it live. Otherwise, I'm wondering if anybody else wants to raise their hand. Any more questions? Nope, I see nobody raising their hands. Okay, so,
well, Andreas, thank you very much for organizing.
Well, thank you so much, everybody, for attending. And again, thanks to Thierry and thanks to everybody here. Next week, we're going to have the last person to ask a question, Thomas Mather, who's going to talk about bond ETFs. And I'll see you all next week. Thank you so much, everybody.
Thank you. Thanks, Thierry. Thanks, Andreas.
Thank you.